news is business, really, isn't it?
It is pretty much dominating, and I'll get to those horrible market numbers for you in just a moment. But first, we start with news that the Chief Investment Officer at JPMorgan has quit her post after a $2 billion trading loss that's rocked the American banking giant. Ina Drew will leave the firm after more than 30 years at the company. She had been overseeing the group responsible for the massive loss. Well, the case has sparked further debate over risky trades and investments by global financial institutions. Well, critics are now calling for yet tighter regulation of the banking sector. Well, let's speak to Chris Skinner. He is chairman of the Financial Services Club. He's in the city for us. Chris, let's just pick up on that theme of risky investments. Many have been calling for tighter regulation of it, but it might not even have worked in this case.
No, I mean, the trader in question is one of the traders here in London. He had a reputation of taking big risks, but having said that, he was taking these risks to offset other investments made elsewhere in the bank, so it's to balance the risks that the bank was taking by making sure that they had hedged them effectively. In this case, however, it looks like some of it was being made for profit purposes rather just for offsetting risk, and that's the part where people will be looking at, what was actually happening in the operation here. Maybe it was bad management rather than anything else.
There was some recognition over the weekend that the company missed early warning signs of these problems. In many respects, that simply plays right into the hands of people who are calling for tighter regulation of these sort of activities.
Absolutely. I mean, JPMorgan's gone through this financial crisis as a steady ship under the leadership of their chief executive, Jamie Dimon. Jamie Dimon has been incredibly outspoken against the new regulatory regime in America, particularly this rule that will split and close down any proprietary trading, as it's called, trading off the bank's own balance sheet. And he called this a tempest in a teapot just a month ago. It's more than a tempest in a teapot.
This does really underline the difficulty that regulators have when it comes to allowing banks still to be competitive, still to go about their business as usual, yet also protecting the interests, in this case, not only of clients, but also of taxpayers.
Yes, I mean, the whole focus is to avoid another bailout, and what most of the industry is saying is that rather than tighter regulation of these trading positions, we need a better regulatory regime for unwinding a bank when it fails. The problem is banks are becoming too big to fail, and that's what, for the taxpayer, our problem has been. And to a large extent, the Volcker rule in America, the Vickers rule here in the UK, which will split investment and retail banking, hasn't addressed that core fundamental yet.
As you said, though, it was the scale of all of this that made the biggest problems. It was meaning that small fluctuations in the market were having a huge knock-on effect for the value of the investments. But you could also say it's the complexity as well. It's very difficult to nail down what asset was paired up with another, what was compensating for a loss elsewhere, and that got everyone into this big mess.
The big mess, to a large extent, Ben, you're right. This particular issue that JPMorgan had, it was a bit more obvious. The trader in London is called the London Whale, or alternatively Voldemort, as in the Harry Potter evil wizard who cannot be named, because he took such big bets, and because of that, he was highly visible to those who wanted to go against him, and that's what caused this downfall.
Okay, Chris Skinner, we'll leave it there. Chris Skinner, chairman of the Financial Services Club. Thanks for your time. Now, I just want to show those market numbers we heard about there in the headlines. And